recording as well. Because why? Because I know Lee's not here, and mostly he's busy working. Yeah, so I still have a live recording for him. So now, if gold come back and retest a higher price, possibly we can look for sell. We understand this about withdrawal liquidity here. Yeah, withdrawal liquidity from market makers. Why? Well, first of all, what do we expect to see in terms of order flow in this candle? What do you guys expect to see? Absorption or exhaustion? Before I obviously go on to the order flow chart. Is this exhaustion or absorption, guys? How's this candle with low volume moving like this? This candle is almost twice the size of this candle. In other words, what's the intention on this candle? What's the intention here? What are the market makers trying to achieve here? Anyone know? No one knows. Stop hunt. Ah, Mark. I like it. Mark's very proactive. Huh? I like it. Absolutely correct, Mark. Yeah. Why? Too many sellers came in here, guys, isn't it? This is what? Kappa price. Kappa price. How do we know? How do we know too many sellers came in? Guys, look at the volume spike. And look at the rejection. Look at the reaction with that volume spike. Too many sellers came in during that phase, didn't they? They came in too late. And guess what? That's 80% HFTs. And unfortunately, 20% retail selling came in into that candle there. Yeah. So they all got stop hunted on the next candle. And they're still trying to stop hunt. Yeah. So now let's go on to order flow. Can we see that narrative? Is there too many sellers come in? Guys, let's have a look. Look at this. 35 against 30, 71 against 58, 35 against 10. Massive sell and balance. Sell and balance, isn't it? During that rejection phase. Yeah, look at the POC. The POC is here, low of the candle. So market maker rotated against all these sellers and hunted their stops on the way back up. Look, the 0, 0, 0, 0. This is what we discussed in the classroom. In the order flow, when you see the zeros, it's a stop hunt. It's a stop hunt. Yeah. So right now on the right-hand edge, we see 17 buyers coming in. And of course, they got a little bit rejected. And 23 buyers coming in, they again got rejected. And buyers started to exhaust. So there goes your buy trade, there goes your sell trade. Possible short scalp, isn't it? Possible short scalp against those 40 buyers who just got trapped. Against those 40 buyers who just got trapped. And of course, now we expect to see a sellers below. If sellers don't come in, stop loss to break even, guys, on that trade. Yeah. Do you understand? Okay, but ideally, like Mark rightly said, we're still a bit early if we took that trade, isn't it? We're still a little bit early. Why? Because although buyers are exhausting into the highs, we're still looking for this stop hunt across this 38.60s, across the 38.60s. Ultimately, that's what the market makers are trying to achieve. Whenever a little bit of selling comes in, the market makers are going to rotate against those sellers and trying to bring the price back up until, okay, now what happened? 27 buyers there again got jammed. So now it seems market makers, they perhaps might be rotating 52. Is this good enough for a sell trade to go against? Sell order right now. Sell order right now. Based on this chart, we don't know value, obviously. So that's an edge that we currently do not have. But obviously we can turn on value, right? Sell was dropping, copper's dropping, guys. Would you sell? Would you sell? Yes or no? Would you sell? Yes, no, yes, no. I need an answer. 73 against 0. Massive buy and balance. Mark says he will sell. There goes the sell trade. Mark's sell order goes right against this 37.5s, 37.5s currently. Phoenix will sell, absolutely. Yeah. So if now market makers stack against this, the next candle should do this. So let's see into candle close. Yeah. And the good thing of trading like this is what, guys? If this goes for the stop hunt, guess what? We're not a victim of the stop hunt, are we? Because then we just get the ability to trail our sell stop higher, 29, 33, into a stop hunt. Do we still have value? Silvers went up. Okay, so we lost a little bit of value. So let's see what happens. Lost a little bit of value, which is not ideal. Copper's going up as well. Okay, so we kind of lost a lot of value, actually. So if we sold against this, if we do sell against this, stop loss goes very tight, guys. 10 ticks, 6 ticks, like upward. And when it drops, we need to see sellers below. If sellers comes in and then get jammed, guess what? Market makers are still rotating bullish. We tighten up the stop loss. We tighten that up. And we start to bring the stop loss in carefully into break even. That's a trade gone. Oh, that's a trade finished there. And we're just trying to see if value can drop. We need value to drop. We need silver to reject off the high print. We need silver to reject off the high print. If silver do not reject the high print, we will get stopped out, and we get stopped out at break even. And we try again into higher prices because we lost value on that trade. Do you understand? We lost value. But because of our execution, we're able to get out of that trade without taking the loss. Because ultimately, as retail traders, this is the thing we're doing. We're gambling on value. This is a risk we're taking. As a speculator, this is the risk we're taking. Now, 10 buyers seems like they're exhausting. Market maker stacking against these buyers. So perhaps we could go again at lower prices, isn't it? Those 10 buyers that got jammed didn't move price. Now value is developing on the short side. So sellers are coming in. The market makers seems like they're stacking against these sellers. Not good news. Not good news. Not good news. Yeah. So there goes higher price. You stop, get stopped out, get stopped down on that trade. And you try again at higher prices. Try again at higher prices. 41 buyers. There you go. You try again. Do you understand? So this is how you manage your trade very effectively, very proactively. You don't just sit, people do this, they put a stop loss here, they do the fancy stuff, they put a TP here. Guys, we don't do that trade. You need to be very active. If we've lost value, you bring that stop loss in because I don't want to take any more heat. I don't have value. I don't have a reason. I've lost the value to sell that trade now. So why do I put my stop loss all the way up here to get hit, to suffer a bigger stop? If it goes to a higher price, guess what? 41 buyers. Okay, I've just hit a small stop. I try again, don't I? I try again. Get back into it. Get back into it. Hopefully value can develop, and value still isn't developing. So guess what? On that trade now, stop loss again to break even. Stop loss again. You just bring it to break even. We need silver to drop. Silver is not dropping. That's a concern, isn't it? And we don't see sellers at higher. We don't see sellers at lower prices as a result because sellers are not dropping. So as the trade drops, we need market makers to withdraw liquidity. Market makers to withdraw liquidity, not stack, withdraw. And they're still not withdrawing it. So if that's the case, guess what? Take a little bit of profit here, isn't it? Partial profit take. Now we see sell dropping. Okay, well, I don't know why that chart delayed. Okay, and guess what? Take a little bit more profit here. Yeah, and let's see if value continues to develop, which is good. Now, market maker should withdraw liquidity. Market maker should pull the bids, to let price come back to this print. If it come back to the highs as a stop hunt, we try again into a higher price, don't we? We try again into a higher price. But this trade is not protected. So buyers are really starting to exhaust, isn't it? 7/4. So this should rotate down now. This should, as an expectation, rotate down. We have value. We don't have many buyers. So let's see if this POC can hold into the 38 sixes. Market makers are stacking against these 6 buyers, which is good news. So it should reject 7 buyers. And let's see if it does reject. It does reject. Okay, no, buyers are still coming to higher prices. 2, lack of buying, but they're still coming in. But this is a selling balance, isn't it? 15 against 2. It's a selling balance. So these sellers should push the price down. If they don't, we understand market makers are actively rotating these sellers higher. So they should push the price down. If they don't, guess what? If they don't, perhaps you can close your position out here. But if your stop loss is already break even, why close it out? Just see if value can develop. Just see if these sellers can push price, isn't it? There's no harm there. If they do push price, we get a low, we reach profit. Currently value is very good. Market maker still stacking against the sellers, which is not ideal in terms of price action. We have value, but we don't have price action, guys. We don't have price action. Price action is a little bit sticky. Yep. Little bit sticky on this 1 minute chart. Here it goes. And still no. Okay. Really good value. Really, really good value. Listen, really good value. So if we get taken out here, what's the next sell trade? Sell trade goes up here against the highs at 39 evens, 39 evens as a trade narrative. If we get stopped out here, 7 buyers, maybe that'd be good enough, but market makers start stacking. Let's see. When you take this trade, you take profit here. Your next buy limit automatically goes to the 36 fives. Your next buy limit automatically goes here as a take profit. Okay, now we're starting to lose value. Okay, this is not good. Start to lose short-term value. Why? Silver and copper's ticking up in the last minute. Silver and copper ticked up. Yeah, so we lost a little bit short-term value. Volume is rising, but candle size is small. volume is rising, candle size is small. You're referring to this part here, right, Mark? Yeah. Yeah, absolutely. That's the absorption phase, isn't it? That's the absorption phase there. Yeah. Why? Why they absorb? Because there's value for sell trade. We're looking for sells at higher prices on gold. But understand, the sell trade, right now the value is good. But obviously, we're still fighting against the macro shape. The macro shape ultimately is still buy trade, guys. That's why our take profit is quite tight. Oh, hold on. I'm going to 5-minute chart. Yeah. Macro shape is still buy trade. You can see gold is here, silver's here, copper's here. So we don't want to sell for a swing. We want to sell for a scalp. Yeah. Short sell for a scalp. Obviously, when it drops, we buy it back. We buy it back for a macro swing trade. But guess what? With order flow, with value, you can trade anywhere, essentially. And here comes the sell trade, isn't it? Here comes the sell trade. A little bit, okay, 2-minute sellers. 18 against 10, sell and balance. 12, let's see, the market maker needs to keep stacking against these buyers. If they don't, the price is going to go through the top. If they do not, the price will go through the top. So let's see, and we've lost value here as well, which is not good. Yeah, no ideal. Guys, what do you think? No ideal, right? Copper seems like copper got bought, silver's still dropping, which is not too bad. 5 against 3, we still have a little bit of sound balance. Sellers are still pressing the higher prices, which is ideal. Buyers exhausting. Now it's coming back to our stop. If it does, guess what? We try higher prices. That's trading, guys. That's trading. That's proactive trading. And this goes to trade. A stop loss at break even. Now, hunting through the high price retest. We didn't really see any chat buyers. Oh, actually, didn't hunt through liquidity. The pin was here. The 38 eights. The liquidity is at 39 evens also. So we got unlucky on that trade. We got unlucky. Now, if it drops, we just got unlucky. We got stopped at break even and it dropped. There's nothing much we can do, is there? Number one thing is we have to make sure we don't lose any money. Number two is if we get lucky, guess what? We make money. Yeah. But people usually get this the other way around, isn't it? People focus too much on making money. And as a result, they actually lose a lot of money during that phase. We're fighting against the trend, and yet we've took 3 trades, 1 stop at break even, 1 small stop, and 1 profitable trade. And we're fighting against the trend. The trend is bullish. So that relies on our execution, isn't it? This is quite a balanced order flow. Quite balanced. Now it's become sell and balance. We're gaining value, but we don't have a higher price. I'm only wanting to sell at the liquidity. Why? Guys, why do I only want to sell the liquidity? Why don't I just jump in and sell here? What do you guys think? We're getting value, yes, but why not just jump in and sell here? Why am I only waiting for the higher price? 5, okay, not good enough. A little bit buyer trap rejected. Professor Ball, hello.
Morning, good morning. I just wrapped up with Dr. Raoul and had a nice jam session with Dr. William yesterday, so I just thought I'd run in and say hello.
Good morning to you too. How are you? You woke up very early today, I saw.
You know what? I'm getting less sleep than I need.
So what you're saying is you're feeling younger.
Yeah, well, listen, I'm pushing the upper echelons. So my colleague from Miami, he said, "Dude, you should have been retired 30 years ago already." the way that you work, So
Absolutely.
I see you got some footprints going on. Very interesting. You're
we do
watching gold
indeed.
versus what today?
Watching, we kind of went over the narrative today because banks are actually closed today, which is
I
not,
know.
yeah, not ideal. But for the people who are attending today, still want to showcase something, trying to keep their content consistent. Hopefully, provide some value to people who are interested. Especially now, I have a couple of people attending quite consistently, so I want to, I don't want to let these people down, especially. But yeah, today, gold, not really. The only opportunity I highlighted out was NASDAQ into the 21,300. Oh, okay, now we actually see it really making a progress, guys, yeah? Really see it making progress. Yeah, nice, good trade outcome on NASDAQ. Yeah.
My question would be for NASDAQ,
Yes, sir.
globally, I would ask myself, okay, where are we with regards to the Chicago annual ranges? In other words,
Oh,
From when we started in January, if I
Mhm.
look at the first few weeks of the year, are we coming back? Are we beyond it? I'm looking at it from the macro perspective also, like you are. Where
Very
are we with
macro.
regards to the way that the big players are playing, right?
That's very macro indeed. Let me dive onto the 1 minute chart, which I use not so often at all. Since the start of the year, you said, right?
I'm
So,
saying January for sure. I'd be looking for the first two weekly candles. I would go to the weekly, so it's just easier for you to see it. If you go to
okay.
the weekly and just see what the first two weekly candles look like for
So,
January, for the beginning of the year.
2 green candles, and I just mark this level.
Yeah, just mark that level. That's the Chicago numbers. That's the high and low for the annual ranges for Chicago. I
Uh-huh.
want you to notice something.
I've already noticed it. Rejection, rejection, and rejection.
Yeah.
Yeah.
So this is some of the bigger houses out there, the J.P. Morgans of the universe and whatnot. They're
Yeah.
still doing what the same old dogs did 30 years ago. They
Mm,
mark off their Chicago numbers, and they know how to play when the price reaches the Chicago numbers. They all start buying like crazy. Look at that.
yeah.
Look at the rejection the second time.
Yeah. And I can see they're holding
They
that
all
70,
bought. They all bought
70.
like maniacs.
Yeah.
Now, if you look carefully at the time of the week and the time of the month, that also gives you a little bit of a clue, I would think. Why? Because humans who work and have pension funds, and pension funds need to be paid every month, and the company pays a half and you pay a half, and it's called the IRA Roth in the States, and every country's a little bit different, but it's kind of the same.
Hmm.
Now, what happens when all that money is coming out of your paycheck and it's going to the pension fund? Well, the pension fund has to give it to the hedge funds and all the other places,
That's
and
right.
they have to deploy that capital somehow.
Mm.
So even
Uh-huh.
just being just a human observing from the planet Zoltan over there, you know right away that at the end of the month and the beginning of the following month, there's going to be a little bit of a lift, only because so much capital has to be deployed because it's hitting everybody at the same time.
Yeah. I've noticed what
Just a
tends
couple
to
of this.
happen at the start of the months. It sets a narrative. For example, this is what September. If the start of the months is bullish, likely continues for the
Yeah,
rest of the month. And
yeah,
if it goes bearish,
that'll happen too.
yeah, yeah. So that's a possible narrative that I do watch. But of course, no, this is this is beyond my patience in terms of time frame. Yeah, it's really high time frame indeed. So
Yeah,
yeah,
but
this is
if you're controlling a few $100 million, then yeah, you're gonna play these weekly charts on the bigger numbers.
oh yeah, of course. That's where the volume is, right?
You know. Oh yeah, absolutely.
Yeah, I like it.
But anyways, that's what Nasdaq looks like. I mean, if you look at Nasdaq, that's exactly what it looks like. It's coming in and it gets rejected from that zone.
Yeah. And 17,000 seems
Um,
like the key
I'm a buyer. I'm
support
a
level.
buyer all day long, all the way to the bottom of the first candle that came out at the beginning of the year. I'm a buyer from there forevermore. I'm a buyer.
You mean this
Now,
would? Yeah.
give me a Fibonacci from the low to the high, and you can see where
From
we are in terms of discount. Like what kind? No, I would go from the low of the.
oh
Yeah,
from the
I gotta
here.
adjust your discount. Yeah, that's from there.
Yeah.
Are you in the 25, 50, 75? Or are you using the
Oh
old
oh oh.
Robinacci stuff?
And
Yeah, give me the right one. Don't give me
okay.
Robinacci's.
Apologies. Give me 1 second.
I got that from my friend Simpleton. He calls them Robinacci
Let me see
because everyone
the.
who uses them gets robbed.
Yeah. For me, I like the where's it? Okay, let me just have the manual do this. I know you like the
Yeah,
0.25, which it's the same
yeah,
concept that we
25,
use.
30,
Yeah.
yeah, 33%.
Yeah, I
Give
don't use
me
that 33, 67, 60, whatever the number says. I don't use that.
I do all the time because I think of it as a discount. Like I'm going to buy clothes. Oh, 67% off, two-thirds off. I'm in, you know? So just another way. For me, I like to look at, well, okay, what kind of a discount am I getting here?
Okay,
You
so
know?
this is your Fibonacci, the 0, 0.25, 0.5, 0.75, and the 1, correct? Oh, wait. Oh, you have
Okay,
the
so you're
0.33.
skipping.
Oh, wait, hold
I
on,
have
hold
the
on.
3 in there.
Okay, so
And the
let's get a
2.5.
0.25. What's next? 0.33?
You keep that as 2.5, then go 3.3.
0.5, and then
Yep.
6.7?
0.67.
Yeah, and then
0.67. I use 0.75 and then 1.
I like it. Different aspects, guys, isn't it? Different trading aspects. Okay. And in terms of premium discount, we're into premium. So looking for sell trades.
I'm
Right.
looking to buy it when it's cheap, when it's 75% off. Right there. Yeah.
Yeah.
I'm a buyer at 50% off all day long.
Yeah. Key balance as
You know,
well. 500.
I'm a buyer.
Yeah, I like it.
Now let's get clever. Now let's go from the most previous swing low, which would be, no, that's a swing high. You want to go from the low all the way there. Yeah, you want to go swing low to swing high. Now what do we have?
So now, okay.
We have an ability. We can see that this thing can still drop to the 50-yard line.
Yes, for the
Is
rebalancing.
there?
So 50. Yeah, 50 is the
Yeah,
highlight this level.
It very likely could.
Yeah, that's right. The rebalancing.
Now, if you go the other way, which is a little trick that I learned from crazy Dr. Wasaki, from the swing high to the swing low, which would be the left.
Swing high.
The swing high to the left, higher, in the previous.
You mean the previous
section.
swing?
Go to the left.
That's here.
I read that. Swing high to swing low now.
Yeah. And
What do we got there?
That'll maybe a little bit.
Yeah, extend it. It's important. Extend it because I want everyone to see. I want you to see something very interesting. Okay. I was blown away when I saw this.
Yep. So this is high to low.
Look at the 50-yard line and the 50-yard line for both of them.
Yeah, it's a balance.
Look how it's trapped. See that little area between 50 and 50?
It's a battleground, isn't it?
Oh, there's something. Well, I look at it slightly differently than you are. I'm looking at, if I draw from the 50-yard line from the leftermost on the 18, and I draw the 50-yard line from the I don't know what you got there, but that's okay. I would extend that one all the way to the right. Extend that Fibonacci that you had just a second ago, the one on the leftermost.
This is from the
extend that to the right.
Okay.
Yeah, high to the low. So low to high and high to low. Look how the 50-yard lines are almost lined up.
Oh yeah.
So that's a kill zone, baby. You know that you're going flying from there, no matter what.
Yeah, it's going to be a lot of buyers defending it. A lot of buyers.
Oh hell yeah. Oh yeah, because remember, the markets are moving in cycles that kind of fractal in nature, but also people are looking for that 50% discount. That's just the way humans are. So we could go if you want to go to a faster time frame. I've only got about another 10 minutes, you'll forgive me. But if you go to, let's say, a daily.
Yes, sir. Let's see.
Just go try a daily out.
Do I clear the drawings on this? Or we can keep it for now?
Oh, leave everything on. I want to see everything.
Okay. So this is now daily time
frame. Now notice what happened. If you go to the daily, you literally came back all the way from the second one that we drew, right? It came all the way back down to the 11th. I say it looks like the 11th or the 12th.
11th. Yeah.
No, keep going. You're right there. You're right there.
Oh, here.
Yeah. So the day before that was the 17th. The 17th, it crashed through. Right? What do I mean by it crashed through? If you drew the Fibonacci from the 7th to the swing low to the swing high, you came back 50% already.
So from
the daily.
So from here.
From there to there, exactly. From swing low to swing high, you've already come back 50%. So that's no longer a valid, for me, it's no longer a valid swing high. That becomes now, so I get rid of that because it came back 50%. It came back all the way down. So I'm getting rid of that one. And I'm going swing low, which is the one on the 17th, 18th. So I'm going swing low all the way up where we are now. They haven't pulled back yet, have they?
And then you have another 50%, which is here.
They haven't pulled back yet.
Against each other. Yeah.
And what I'm looking for is, can I get a discount somewhere around over here somewhere? Because I know they've got to come back to at least the 25-yard line.
Yeah, as a retrace. Yeah, absolutely.
Because they've got to re-up it and then just launch a bit higher if they're going to go any higher. Again, you can just look at the tracings of what's happening based on swing lows to swing highs and the proper Fibonacci, in my opinion. Just think about it like I'm buying things on sale. That's why I want to buy things on sale.
Me too.
Look at that 50-yard line. I mean, that's a
Yeah.
very, very important level.
Yeah. Unfortunately, Professor, the retail trader confused this with the fair value gaps, the ICT.
That's fine. I don't. It doesn't matter what you call it.
Yeah. For me, fair value gap works. Works in certain conditions. It doesn't work all the time. They get confused when they think it works all the time. That's where the confusion comes, and then they complain they don't make any money. It's just not ideal. But yeah, I absolutely agree with this concept, the 50%. And of course, we can discuss a little bit more into depth. But may not have the time. Why do I refer?
Hey, listen. Let's go. Let's
Yeah.
go down to the 1 minute chart. Let's go crazy.
Oh, now things
You
start
ready?
to get interesting.
I've got 10 minutes.
Okay. So do we
Okay,
do the
so
same?
we know the market opens. Yeah, we go. There's your swing high to swing low. It already ripped through that one, so that's not valid.
No
I
valid.
got to go swing high to swing low the other way.
Swing high. So high to low this way. The
That's right.
current lows here. So this level,
Interesting.
which I do 100% agree
Yeah,
with.
that level's that's a very important. That's a kill zone.
Yeah.
Fair value gap, whatever they call it, banker's pleasure. I don't know. Everyone's got a new name for it. When you look at the market from a perspective of where could the price possibly go to, well, you've got the very low point there, that is your swing low, which your most recent swing low. That's a target.
Yep.
You also have got the 50-yard line up above.
As a possible selling potentials all the way up, right?
Absolutely.
Yeah, absolutely agree as well. I agree. Yeah. I do think that's that.
Sorry, I didn't mean to crash your lesson. I'm sorry about that. I
No, no,
just
no,
wanted
no.
to.
This is a live stream for people to kind of share ideas, open to different perspectives.
Oh, perfect.
That's why I'm quite glad you came in to
Perfect.
share your perspective. And for people who
Oh
don't know,
yeah.
yeah, I refer Paul Diddley as Professor. Well, he's been in the market for longer than I've born, than longer I've existed. Yeah, so that's why he's the professor. Yeah, guys.
I'm the old dog. Look,
Absolutely.
from my perspective, when you're looking at something like NQ, I have to remember that it's extremely, extremely volatile.
Yeah.
It's difficult to get a handle on that horse, as the saying goes.
Yeah.
However, if you catch the right momentum and you catch the right trade idea, where did the market open? I wanted to see where the market opened. Do you have
Yes,
that
sir.
marked off where the market opened?
That's
Where did it
today's
open?
US Open there. We witnessed aggressive rally into
So are we
the
on the 1 minute?
liquidity. Yes, sir.
Yeah. Okay, so give me. I want you to show me the opening range. Let's
Okay,
call it the first 10 minutes of trading.
that would be here.
Where would it be on your map? Okay, so that's the first 10 minutes.
Yes, sir. 230 to 240.
Okay, so what's happened? It completely went bananas, filling in orders that were left over from Friday,
Yep.
and then make it yellow. Yellow's the standard for
Yellow.
us
Yep.
geeks.
Let me put this to 50 maybe.
Opening range.
So it stands
So
out more.
is there a breakup or a breakdown? No, we're in the null zone. We're in the middle of the opening range. It's null. Nothing going on. You don't want to be trading here, especially NQ, which is a more of a trendy type of an instrument.
Yeah.
You want to either break down below the opening range low, or you want to break out high above the opening range high. That's what you want to be looking for as your first pit trade that everyone learns in the pit. Whoever was in there back in the day, the yelling and the screaming and the shoving and the pushing and the hand signals.
Yeah.
This is how they learned how to trade.
Yep.
Waited for the opening range. It could be 5, 10. You could use 15 minutes. It doesn't matter. You want to have those lines marked off in your head because they didn't have graphics and they didn't have computers. They had to jot it down with a piece of paper. All the only other thing they wanted to know was, where did we close on Friday? Because when we left on Friday, we know that the closing price on Friday was the settlement price, was the fair price. Because the battle raged on all Friday afternoon and all morning, and they settled on a price. So where did we close on Friday? That's an important piece. So can you draw that for us, Doctor?
So Friday's close would be
Just whatever the closing price was. And I want to see a nice fat line
so
from
here.
that's it. Yeah.
And
So
I'll make this
nice
quick.
fat line so we can see it. Nice and blue. Something that we can really register.
It's the
I'd like to keep
20.
it solid so that I know it's a
Oh,
solid magnet. Keep it solid for yourself so you know it's a solid magnet.
yes, sir. And that's
Now, guess
the
what?
sentiment price.
The
Settlement price.
60% chance
Yeah.
on any given. That's Friday's close. Holy smokes! Are you sure?
Friday.
Oh.
Yeah. Friday gaps into Sunday. It's here.
Friday 5 p.m.
Yes, sir.
Okay.
Closing price, right? Not settlement price.
Well, I like the closing price of the futures market.
Okay.
So 5
Yes, sir.
p. Yeah,
So
4:59,
that would
whatever.
be
Okay.
yeah. So that'd be the
Okay, so
closing price.
they went bananas in Globex, and
They
look how
rallied
hard
quite hard.
they pushed
Yeah,
really hard. Yeah, they
they
pushed
rallied
really
quite
hard.
hard. Yeah, in the Asian
That
session.
I don't think there's a 60% chance they're going to drop all the way down again.
Me
Personally,
either. Yeah, no, me either.
it's a bit too far away, so the magnet's not going to hold.
Yeah, yeah.
Now, if we're looking for long trades, we're only looking for long trades above the opening range. Period. Full stop. How much money do you need to make? Right? If you're on the different prop firms and whatnot, you've only got to make, I think it's a couple $100 a day. Wasn't that the general idea? I don't know.
Yes, sir. It depends on the account size, but general idea is 2% a day you pass in a week.
Oh, yeah. So if you got a $10,000 account, you only need to make a couple $100. I'm sorry, if you have I guess it's a $50,000 account.
Yeah, that'd be correct.
I would still aim for only a few $100 a month because at least you know you're going to have the consistency and at least you know you can get in and get out, not really sweat it out and worry about going on tilt and really just massacring yourself. Go out with the goal every day. I'm going to make my point. I'm going to make my 2 points. I'm going to make my $200. I'm going to do that every single day because I'm going to follow the same steps and the same ideas. Get an analysis of what's happening. Look at the overnight. Right now we just analyze the overnight basically without even trying, and we realize that the closing price on Friday is way too far away for them to hit for.
Yeah, extended.
It's just too far away for them.
Yeah, I agree.
So it's not a strong magnet anymore, as far as I'm concerned.
Yeah, yeah.
Typically, 60% of the time, price returns to the previous day close.
And that's an edge, isn't it? 60%. You have a 10% edge. It's ideal.
I wrote that. I think I gave that. I have that somewhere. It's a histogram. I sent it out a few times, but I can send it out again.
Yeah,
it's an important piece of information for everybody because they know that there's a 60% probability they're going to hit the PDSC, and it's, let's say, a much higher, much closer to the opening range. And you know that if you're going to be breaking down, you know where you're heading, where the train station is, right?
Yep.
That's really the idea of that trade.
A lot of value shared, guys.
I'll throw that. Hang on, let me throw that into the chat over here. How do you throw it into the chat, Doctor?
So if it's a screenshot,
On the top. There you go. I got it. I'm learning, guys.
Yeah, and this is statistical. Well, it's backed up by statistics.
Now you have you also have an overnight high, which you've already you're tickling it, right? So that's why when I look at the how far it went, I'm thinking to myself, okay, where's the pullback going to go to? Are we going to be looking at a pullback of 25% today, 50%? That's where I start drawing with my Fibonacci's. Here's the SPX histogram. I mean, it's going to be pretty close for. Here you go.
Yep.
Gold is closer to 55% return to the previous day close.
Yeah, and look at standard deviation.
It's a nice little piece of information to have when you're trying to set up what's my battle plan for the day, right?
Absolutely. Yeah. And the thing is, unfortunately, obviously, retail traders don't tend to discuss this, which is why people in the live stream, you guys are getting a lot of value, a lot of value from especially experienced traders such as Professor himself. Now, retail traders don't know this. Retail traders will be buying for breakouts here, which you just mentioned. No buying breakouts, guys, right? Yeah.
Right.
Unfortunately.
Well, you have to learn. You have to see what works for you. Some people are up at different times of the day and night. You guys are in a different part of the world, so I can understand.
Yeah.
What's this, please, again? Okay, that is the histogram of showing you how many times the price returned to the previous day closing price. The SPX is the ES, the E-mini. So it's pretty close for the NASDAQ. I don't think it's going to be that much different. What's that really telling me is that if I can mark off where the previous day closes, I have a pretty good idea statistically. If they're going to hit it or not, or if we have an opportunity that if I see that the trade is setting up and they're breaking out of the opening range, I see that that it's very close. That's pretty much a more than 60% probability that they're going to hit that line.
Absolutely.
I'll take those odds. Odds.
Yep, and the odds plays out over time, isn't it? It's the statistical probability that plays out over and over again.
This is like, I think this is like 14 years worth of data.
Yeah. So when the sample is
shows you
like,
that there's, that's a trade. Yeah. Brother, you're going to forgive me. I got to roll out, but it was nice seeing you.
Always a pleasure, Professor. And I know it's early for you, so I do wish you a great rest of the day.
You guys you've lived your full day already. It's, what is it, the afternoon now for you?
Yes, sir. It's 3:30 in the afternoon.
Okay, perfect. Well, carry on. I didn't mean to crash your party so badly.
Not at all. It's very valuable information, I do believe, for everyone. And again, it'll be the first time they've kind of heard this concept, which is good. Trying to open as many perspectives for everyone, especially. And plus, I have it recorded as well. Yeah, so it's quite good. I have it recorded for people who are interested.
Look, again, you want to get the odds in your favor for every setup that you're going to attempt.
Absolutely.
And for me, when you're dealing with trendier things like NASDAQ, you want to ride that train. To where? Like that's always, you should not be worried about. I mean, entries are entries, and it's important to have a decent entry in context. More importantly, is where's your destination? Where are these guys heading? Because you don't want to stay on the train for too long, right?
You might just stop.
Sometimes you don't want to. Maybe you only want to go for 1 or 2 stops so that you can make your daily, percentage or point or whatever it is you're aiming for. And as long as you remain consistent, you're going to be fine. If you try doing too many things at the same time, you're gonna confuse yourself than anything.
Yeah, I've done that in the past. I fall asleep in the bus, and when I wake up, guess what? The bus went back to where I was. Yeah.
And then you just gave back all the money you had in your pocket, right? So
absolutely,
that's part of it, right? Again, most of the issues that I find with young traders, including myself, I mean, I was a young trader at one point in time.
Yeah,
is we want to make everything by next Thursday, because we got a big party going on. We need to make as much money as possible. And that's really a recipe for disaster.
Absolutely.
The real game is consistency. Find a setup that's consistent and it's very monotonous. It's very boring. But who said you had to be excited? I'm more excited with what I can do with all the capital that I've made. Right? That's where your excitement comes from, not the actual job, because the jobs have always been boring since the beginning of time. But it's always been boring. The job's always been boring. If you're going to take this on as a job, it's going to be boring. I mean, there's camaraderie. You meet a lot of really good people. You come up with different ideas. You come up with different strategies and approaches. It's great. I mean, you really get exposed to a lot of very interesting people and different approaches, which is good. But it's a long haul. And if you think you're going to do it in 1 week, you're sadly mistaken.
Yep.
If you can just stay consistent and stick to your plan, money will follow.
Yeah.
It's the bottom line with this business. It really is.
That's the wisdom. 30, 40 years of trading.
Go for 1 or 2 stops. You just make your $100, make your $50. Everything else after that is just scaling. Now, I know that a lot of the prop firms, well, you can open up a 3rd account and 50, 20 accounts, whatever. That's just another way of scaling, isn't it? Right? Yeah. You're just basically doing the same thing, but now across multiple engines or multiple accounts. But you have to earn the right to get there, right? So stay consistent, stick to your plan, and find a move that suits your personality. I'm a high-frequency trader guy because I don't have the patience to wait around even an hour, let alone a minute. So But for people who are doing more of a swing trading type of situation, and it suits your work, if you got to work during the day and you're putting on a trade on Euro USD and let it ride until I come out home from work, you have to find the setups and the approaches that suit your personality and your lifestyle. I always say to people, trade your lifestyle. If you're a student, you're going to school, this and that, throw on the 4-hour dojis and say goodbye, Do the swing trade that lasts 3 weeks. Who cares at that stage? You're in school. You don't have time to look at this all day long. You shouldn't be. You should be focusing on your studies, right?
Yeah.
So, again, trade your lifestyle and trade your personality, and you'll be fine.
Wow. Valuable wisdom, indeed.
Because everyone's different, and everyone's going to approach the market differently.
Absolutely.
If I've got a full-time job, I can't play New York because I'm still, I'm not even on my lunch break when I'm in Europe or whatever. I mean, you got to remember to play according to the dictates of your life now.
Yep.
So, your lifestyle and play your personality. Some people want to get in and out. Some people want to hang on for a week and make as much as possible, or they're doing something special. Decide whether you're a swing trader or more of a day trader. Decide whether you have the time to do either of them. And then focus your attention on, okay, right. My personality is I have the time, I have patience, I can do the swing trades, I want to make the 3-to-1 risk reward, whatever it is that you feel connects with you. Then see whether or not it can actually be mapped onto your actual life, right? Your lifestyle, whatever you're doing in your life, you're working, your school, whatever, right? So get those two things lined up. Come up with a nice little maneuver that you like, that you've tried. Try it out, and just be consistent. And you're gonna win this for sure. It's gonna take you a year, but you're gonna look back and laugh. That's what I did. I've been playing with the markets since 2016.
Yeah, that's what you did 10 years ago.
The goal here is to just be consistent, and it's just a slog. I'm not going to lie. It's running a marathon, man. You better have a lot of good music on. It's just like, what? So.
Yep.
I got to run, my friend. It's 10:30. I'm late.
Yeah.
We'll
Well,
speak
thank
soon.
you very much for holding in. And catch up with you soon.
My pleasure, guys. Any questions? I'll answer them next time I come by.
Absolutely. Always a pleasure to have you in. Professor?
All right, brother. Be well.
Well,
cheers.
Take care for now. Bye-bye. Oh, wow. That was wisdom, guys. Very good wisdom. And surprisingly, not surprisingly, guys, the things he talks about. Well, first of all, a little bit of background, guys. Yeah. Paul Diddley, professor, which is who I refer to. He's he may not look like it or sound like it, but he's actually a seven figure. He made 7 figures from 10 years ago, guys. Okay, so that's why I take. Oh, first of all, I give him a lot of respect. Yeah, and we understand he's a very good trader. Yeah, he likes to keep things simple, and the results speak for himself. I've seen I've seen how much money he's made. I'm not joking. 7 figures is a lot from trading yes. Okay. So with that being said, now a lot of the concept he's covered, which a lot of it is true. He was involved in the pits, which we've discussed, especially for Classy, who's in the classroom. This is what we covered in the introduction, isn't it? In the pits where people were shouting, the locals, the commercials, they have the jackets on, the market makers, and there goes a breakout on Nasdaq. Yeah. But anyways, yeah. So back in the pits, he was one of them. Yeah, guys, he was one of them. And of course, he's been in the market for longer than I've existed. So 30 years minimum, 40 years perhaps. Yeah. So Kawase says, yeah, I remember about the pit you talked about. Yeah, absolutely. So he was one of those guys. Yeah, he really is. So he has a lot of experience that some of us, unfortunately, well, never have because we were not born. Yeah. So, and what he says, the concept he talks about is absolutely true. In regards to closing price. Now, Mark said, "What is this?" Yeah, when they first showed me, I was a little bit confused. I mean, I understand, the standard deviation, obviously the histogram. It's not difficult. It's not a complex graph. And for SPX, which is SP 500. And yeah, so a lot of stuff, especially when we're doing sample testing to that degree, we're talking about 14 years of data, right? So guys, that's a huge sample size. 14 years of data, there's 300, well, 200 trading days in a year. So, you get the point. That's thousands of days in terms of examples. So from the skew or from how the data presents, there is a statistical edge that we cannot ignore. Meaning, if you simply trade the price back to the closing price, every 10 days, 6 days will work out. That's what 60% means, right? So over in the long term, it is a strategy, it is an edge in itself. In other words, it is an edge in itself. Now, obviously, the way he does, I personally, I don't like to be rude, but I don't like I don't like the 0.33, the 0.75, 0.67. In terms of his extension, you guys know it's a little bit different from mine. I like to extend structures, which he does as well, yeah, which he does do this narrative, but he just draws a box. He does this, and then he drags a box like this, and then that's his target, which I just use the extension. But he uses in the way that we've seen, right? In terms to measure price discount, the 25.33, that's a premium. Well, depends how you draw it. And then the 67.75, that's a discount. Yeah. So it's still similar concepts. Listen, similar concepts in measuring price discount. And obviously the 0.5 is where we pay the most attention to. And the 0.5, as we discussed, it's where the battlefield gets held between the buyers and the sellers, isn't it? Where the battlefield gets held between buyers and sellers. And a lot of ICT traders know this as the fair value gap. Well, guys, the fair value gap only works when the market swings. It doesn't work when the market's consolidating. Yeah, so understand that. That's where the people make mistakes. You don't take fair value gaps everywhere. You take the fair value gap when the market extends and then retraces, because the buyers have to defend the level, and that's the level they are ultimately defending. Yeah. So a lot of concept now. That's only a little bit that he shared. He's kind of shared a lot with me back in the olden days how the pits really used to trade, and I've learned a lot from him, and I still continue to learn a lot from him. I'm not gonna lie, he's a really, really good trader, guys. He really is a good trader. But nevertheless, let's go. Let's go back to our topic. Yeah, okay. I'm glad Nasdaq played out. Really glad Nasdaq played out, which is good news. Yeah, guys, good news. But anyways, well, what about gold? We were looking for sell trade on gold. Scalp short, scalp short. Where's that scalp? 1 minute short. I've lost it. Okay, we were looking at this price. Okay, went a little bit higher. We lost a little bit of value. At the time we discussed, we were losing value. We lost a bit of value, and then scalped off the short. Scalped short of the higher price, which is fine. Okay, but now we are at half three. The main opportunity today really was Nasdaq. To be perfectly honest, guys, why? Because Nasdaq held the most value for today's market. Nasdaq, after H's pump, it really pushed it into extension. Really, really over. Okay, a little bit too bright here. Really overly extended, didn't it? Really overextended. That's why we're looking to sell Nasdaq back into some sort of fair value, which Professor mentioned is the 50%. Now, I don't think it's going to reach the 50% into US session, but perhaps in the late US session, it's possible. Yeah, it's possible. But for today's session, unlikely. We already highlighted where the sell was going to come from, and it came from there, and hence it's now dropped and it broke support. And so for me, Nasdaq, if obviously that's a trade there, and where is likely to be the target most likely, in my opinion, is where is this extension here in terms of price, in terms of structure. It's this 21,220 as a target. So that's around 80 points move on Nasdaq, and we can see that now it's heading towards the target. So into there, probably before London close, we should meet that price as an intraday trade narrative, as an intraday swing narrative. And of course, if we look at value in the background to ensure that value do still stack up with us, but we don't want to see Russell. Okay, so based on current value narrative, Russell really crashed. US 30. It's not disagreeing, but not disagreeing. In other words, it's fair value in terms of US 30, isn't it? Nasdaq is fair value in terms of US 30. So we should meet this target, or ideally, that's the price that we're looking for. We understand there will be distribution happening from this 1.5 standard deviation onwards, which is currently what we've seen. Why? Because the sellers who came in here, that's their target, isn't it? That's their target. Why? Because we just draw that extension. That's the 2 standard deviation there. Yeah. Okay, so we ask a lot of whys in trading, as we should, because every why we need to find an answer. And every question that gets raised is usually linked into commercial behavior, because commercial has a similar decision they need to make. For example, into the higher price, the question we got to ask is the higher price going to break out, or is the highest price going to reject? Well, guess what commercials are thinking? Commercials are thinking they're going to reject the higher price. They already know the answer. We just need to find out what their answer is, don't we? And that's what we do. And we find out the answer with hindsight. Obviously, they rejected. But before hindsight, at US 30, US cash open into the high price, into liquidity, we already have an expectation that the high price is likely to reject. Why? Guys, anyone know? Mark should know. Let me hide some of the indicators. Let me hide some of the drawings. Look at this chart. Just these three markets: Russell, YM, and NASDAQ. Where's the highest swing high? Where's the highest swing low? Why do we think this high price? In other words, why is that premium? Because commercials only sold it because there's premium, right? Otherwise, they won't sell if there's no premium. They won't do anything. They sold it because there's premium, there's value in selling NASDAQ higher price, which we knew. But how did we know? Anyone know? Apart from me. Why are we selling this high price into US Open, guys? And we also highlighted that, obviously, the 300, I'm not going to insult your guys' intelligence. We mentioned many times. 300 is a wholesale level, wholesale price. Yeah, a lot of liquidity. So if anything, that's another decision they have to make, isn't it? Only NASDAQ had liquidity sweep, absolutely, right? So if we mark now the highest price, because a lot of people get this value narrative kind of confused, which is, people mention, Eric, the chart's not scaled, it moves ups and down. Well, okay, if it's not scaled, guys, we can scale it. We can scale it like this. I don't know, manually scale it. We just pin the highest high to the price action. And guess what? Oh wait, hold on. Or maybe we can scale like this. Can we manually scale this? I want to find a way we can manually scale the chart so people don't get confused on this narrative. Yeah. Okay, perhaps if we manually scale it, guys, it may look like this. Okay, and the chart's off the screen. What I'm trying to do is make the highest high to match this candle, this high here. Because when US 30, they made a high there. That's where NAS made the highest high there, isn't it? And when Russell made the highest high, well, guys, it was back here. Yeah. So Russell had premium for this whole upper accumulation. But then we understood US 30 was what driving US 30 was what was driving NAS 100 at the time, right? Because Russell obviously dropped off and NAS was still going up. So there must be a reason for NAS going up. And the reason is US 30 was also going up, right? So US 30, in other words, was driving NAS during that phase. Okay, so let's see, maybe we should scale like this. Okay, now the price action is going to become really squeezed. But you get the point. We're trying to find the highest high on Russell, which was here. We just draw a line, guys. We draw a line like this. And then on US 30, we draw another line. And then people start asking, how do you know that's the highest high? Well, we only know it's the highest high once it's made a higher high and it rejects and doesn't make another higher high, right? So at the time, for the time being, that's the highest high both markets made. And therefore, that's the highest high I'm looking to sell against. So into that, we already see a quick sell there, isn't it? When both lines dropped. And then, look, NAS wicked and then dropped. Yeah. So in that case, at that time there, yes, we lost some short-term value as US 2000, Russell got aggressively bought. But into the higher price, we still have a macro discount, guys, macro premium into NAS. That's why I was looking for sell trades into higher price. And then now you may ask, okay, what price? How did you get the 21,300? 21,300. Well, that comes from, if the short-term value is bullish, we already know this is a wholesale price. If anything, that's where the liquidity is, obviously. If anything, that's where the liquidity lies. And then a structure, the rest is down to a structure, isn't it? You just draw the extension from the last swing because this is where the buyer pushed. This is where the buyer came in. The buyer came in here, and especially here, because this buyer made that move. So I want to know where these buyers are coming off. And these buyers are coming off into, surprisingly, not surprisingly, the same price point, right? So we have two confluences already in terms of price structure. Wholesale price and sellers profit take. Sellers, so all over the place today, guys. Buyers profit take. So there's going to be two sellers at this level already that we know from price, from structure. Now, rest is just down to value. Rest is down to value. And do we really get value? Clear value? Unfortunately, not really, guys. Unfortunately, I have to be honest. Why? Well, Russell rallied during that phase. US 30 was also rallying. So we didn't really get clear sense of confirmation during the small time frame, during the shorter time frame on that phase. So we know that the better short trade was actually Russell, and the shorter time frame was actually Russell, wasn't it? So either way, we still got short because there's macro divergence, massive macro divergence. US 30 here to here, not so much. Russell here to here, a lot. And then, of course, NAS, yeah, you see the divergence playing out, right? So that's what we're looking for short trading in this first place. And not just this chart, obviously, and this chart as well, guys, this chart. We already discussed this chart, isn't it? Today's opportunity was predominantly the two markets that was widened massively. And what's the expectation we made at the start of the live stream, guys, if you guys can remember? The expectation was oil will continue to drop. And as a result, bond will continue to rally. And if that happens, dollar is going to hold that bullishness. And guess what? We buy gold. We buy gold, isn't it? Yeah. And since then, okay, gold's not went anywhere, guys. Apologies. So the trade is still on copper, isn't it? Still a buy trade on metals, but it's not gold because gold is at a higher price. So we buy copper, we buy the market. That's at a lower price. That's discounted. So still, so far, that narrative still seems in place. Narrative is still in place. Yeah, so let's come back to coming back to how we trade again. Listen, sometimes the expectation plays out. Sorry, the expectation should always play out. If it doesn't play out, we understand something's changed. We just look at this chart, and this chart will explain why our expectation did not play out like Friday. Friday, the expectation did not quite play out, and we understood the reason why it didn't. Right, but usually when we have an expectation, we have a narrative. We take that narrative into the chart, into the market, and of course, there's some edge built into that narrative because that narrative will always be inflation against bond, and every other market will evolve around this narrative. Why? Because this is what the commercials are trading. Commercials are looking at this chart. They're looking at this line alone, which is the tut, not the tut. Sorry, where's it? Where's the twos? I can't even remember the symbol now. This is not good. Not been trading bonds for too long. ZB, UB, what's a front end? ZB, UB. In other words, it's a twos tens. We can even use U's. So US 02. It's not futures. The two, guys, bear with me. It's this narrative here I'm trying to showcase. The twos minus US. It's the 2-year yields minus the 10-year yields. That's the short-term yields. Okay, what's going on? 0.5 year. It's this narrative here, which, okay, that's a twos fives. The twos tens curve. Twos tens curve. Which is, guys, is this line. Where's this line? Guys, 1 second. And I'm just going to put inflation, put bond, and the curve. Oh, okay, not great. US Bank is closed. Apologies, guys. Well, we can do some backtest. But this, you don't have to use the yields. It's because I cannot remember. I cannot remember the treasury notes. ZB, UB, 30-year Ultra, ZF. Okay, it's coming back to me. ZT. Yeah, 2 years. So ZT times 2, twos minus ZF. ZF is 10, so it's ZT. This is a 10. No. ZT, ZN. There we go. It's the same narrative. You're just using bond prices instead of yields. Oh, why is this not working? ZT times 2 minus ZN. Oh, because I've got ZN times ZN. Very dumb. No? Ten, twos. Oh my God. That's no good. Okay, there we go. There it is. Yeah. So, what we're looking for. First of all, this is two negatively related. Negatively correlated, which we can just flip this. Flip it, and then it'd be a positive correlation. Yeah, I like positive correlations. And we can see that if I hide the rest, these two, very, very tight correlation, isn't it? Very, very tight. And there should be a very, very tight correlation because it's the yields against the bond, the treasury notes price. Yeah. And of course, we trade a bond against this yield. That's how I used to trade bonds. You trade the 2 times curve against the 2 times yield. But anyways, so at least we understand they're very tight. Because the US bank closed, that's why the yields is not printing. So this is an alternative we can use. We can take the yields away. We can just use the 2 times curve. 2 times curve. Okay, so if that's the case, now let's measure the 2 times curve, which should be a negative correlation to bonds, which means it's a positive correlation, or should be a positive correlation to inflation, isn't it? So now we've got another confirmation to measure inflation. The two green lines should predominantly be positive correlated. Yeah, which no, we don't know which line's which, so maybe I don't make this green. So we can make it blue for the time being. Yeah, if inflation rallies, two tends to rally, and vice versa. Yeah, and we start to see this bubble forming. When this bubble forms, guys, guess what? There's a trade. Where's the trade? The trade most likely is on bonds. Some bonds. Yeah, because if inflation drops, people are going to sell 2s10s. People are going to, I don't mean people, I mean commercials are going to sell 2s10s. When they sell 2s10s, the front end of the bond, they're going to buy the back end. Because when it comes to bond, it's all about spreading the front end against the back end. So when they sell that trade, I buy a lot of bonds. I really do buy a lot of bonds into that phase there. When I know that they're going to sell the blue line, I buy a lot of candlesticks. Okay, so that's another confirmation we can use, right? That's another confirmation we can use to analyze whether inflation is correct or bond prices is correct. So right now, if inflation agrees with 2s10s, then I look for times when they get out of shape because they should agree predominantly. When they disagree, we'll understand bond is parallel shifting, or there's no narrative in the background. Yeah. So this is a very good line to use as well. So I can see right now, 2s10s has overly extended. Inflation already dropped. So if inflation drops, and guess what? People are going to start buying 2s10s. And as a result, if they buy 2s10s, we're going to see selling on bonds, sellers on bonds. Yeah. So that's another narrative we use for confirmation, of course. But I understand people don't trade bonds. But you can use it to help your understanding with bonds and also inflation. This is what commercials look at, the 2s10s absolute, the 2s10s. Yeah. Very good narrative, regardless. Okay, but now we have 10 minutes till London close. Again, don't think there's going to be much trading opportunities now. We already said the biggest opportunity was NAS, and since then, we got the narrative right. And if you did trade NAS, probably 100 points dropped by now, so that's a lot of profit. But in regard to the rest, another trade perhaps that I'm looking at is a buy trade on copper. But now, is this buy trade on copper good or is it not as good, guys? What do you think? Is a buy trade on copper good or is it not as good? If it's not as good, why do you think it's not as good? It's definitely not a buy trade on gold, that's for sure. If anything, it's a buy trade on copper. But is it good or is it not as good? And I want to zoom in and I want to zoom out. I want to zoom in again. I want to zoom out. Yeah. So what's the issue here? What's the concern? What's the concern with buying copper, guys? What do you guys think? Mark, what do you think? Classy? Berry? I don't think it's that good. Just so people are confused. I don't think it's that good. Yes, short-term scalp buy copper, but why is it not that good? And the answer comes from this chart when you zoom out. No one knows. Okay. Well, guys, when you zoom out, it's not as discounted, is it? It's actually premium. So there's a conflict between short-term micro. There's a conflict between micro narrative and macro narrative. Macro is premium. Micro is discounted. That's good news cancels bad news. So short term, I want to buy. Long term, I want to sell. So this buy trade, we understand. It's not as good because long term, I still want to sell. I don't want to buy. If I buy, I understand it's a scalp buy, scalp buy trade. Listen. So it's not as good, not as clean. In other words, you can still buy it. Don't get me wrong. It's not as good as a buy trade. right? Not as good as a buy trade. Not going. What I mean by not as good is it's not going to make you much profit. Obviously, it's a scalp buy trade. You know. So apart from that, not really any other opportunities I can see, which is unfortunate. Well, it's not unfortunate. It's just the way that today is. The market's closed. The market's closed. London. Oh my God. Whew, I think my brain is also closing. Uh, banks are closed, guys. Banks are closed. Banks are closed. There's not much trading activities. Not many active commercial operating, if any. Not any commercial activities, right? So on that note, is there any questions that you guys may have for the live stream? If not, I'll go get some food and get ready for the Blue Guardian podcast. And hopefully I'll see you guys in the Blue Guardian podcast. And then it's a TT classroom, 6 o'clock, as always. Mark, you're most welcome. You're most welcome. And the Barry, when you look at correlations between NQ and others like yields, can we guess short-term movements? I don't look at NASDAQ against yields. I look at NASDAQ against inflation, against bonds. And then from that narrative, I look at NASDAQ. Okay, so it's this overall picture. I mean, you can look at yields against Nasdaq, but you're skipping like 3 steps. You're skipping the narrative to get to an answer. If you skip the storyline, you're not going to know what the storyline. You're not going to know what the story is, do you? It's like you're reading a book and you skip 3 pages, try to understand what happened. You're not going to know, right? So the narrative. Okay, so Barry, for you, okay, quickly go over this again. Yeah. So this is 2 cents. This blue line. And this blue line should confirm inflation. And inflation confirms bonds, which today, so now let me hide in all the other lines. And just leave the blue line is Dix. Okay, let's not make this blue then. Let's make this red for the time being. So this is, what I'm looking for is this narrative, Barry. Is if inflation drops, bonds should rally. But I only know if inflation will drop, or if this drop is correct by analysing the 2s10s, which is the yields, which is a front, whichever you want to call it. The US yields is correct. The 2s10s curve is also correct because it's the same thing. So if 2s10s drop, then understand inflation is going to drop. Listen, inflation is going to drop. And during that phase, actually, it was a sell on inflation because inflation dropped after the curve has dropped. So after the curve has dropped, bond rallied. Guess what? It's a sell trade on WTI. Sell trade on oil. Sell trade on oil. Sell trade on oil. Until this narrative here, it flipped. Then it becomes a buy trade on oil, isn't it? Buy trade on oil for the time being. But anyways, so the storyline is this, or the narrative is this, is when inflation drops and when this drop is correct, I think bond should rally. Okay, so right now, inflation rallied. So right hand edge, guys. So hold on, let's go to the right hand edge very quickly on the 1 minute chart, guys. Here, right now into bonds. I'm looking to sell bonds into this against this higher pivot. I'm looking to sell bonds. Why? Let me take equity out of the window. Inflation's agreeing with the 2s10s, and the 2s10s made the highest high here. So that means that's where they drew the line, isn't it? 2s10s made the highest high here. Inflation made the lowest low. Jesus, start that again. 2s10s made the lowest low here, which bond made the highest high here. Inflation made the lowest low here, which bond made the highest high here. And since then, they've not made a higher high. So any price now I get above this high, I'm looking to sell bonds. So we should see selling come into bonds. Okay, so now you may ask, okay, what does that narrative mean? Anything to do with NASDAQ? But if I think that bonds is going to drop as we see it down ticking right now, guess what's going to happen to dollar? Dollar should drop if it's not already dropped. If it's already dropped, then obviously, well, it makes sense, right? The narrative makes sense. Someone's already sold dollar before as we're discussing this narrative. Yeah, but if dollar's not being sold, we expect dollar to get sold. So if dollar gets sold now, we're coming to NASDAQ. Obviously, as we discussed, NASDAQ already been sold ages ago. Okay, but what I'm expecting now is, do you see that the white line the white line downtick as the bond downtick as a candlestick downtick? Look. That's a selling in bonds, isn't it? In the last 2 minutes. Crazy how we know this, guys. It's really crazy how we know this, isn't it? Well, not really. If you join the classroom, this is an hour of us doing this. Yeah. So it's not crazy. This is an expectation. And it's just crazy how often it plays out once you understand it. Someone's actively selling bonds from the high price. And nice. And dollars dropping, right? Nice. Yeah. So if that's the narrative I'm going after, Barry, then if equities are high, if this blue line is at a high, like here into cash open, now guess what? I want to sell NASDAQ. I want to sell NASDAQ. Yeah. Which brings us to where? Which brings us to here. Here. That's why into cash open, I was looking for a short a sell trade into NASDAQ. But this doesn't come directly from inflation. It doesn't come directly from the 210s or the yields. It comes from Dixie. And also, Barry, to understand that during US session, we don't tend to lean too much on this chart, on this sentiment chart. We don't lean too much on this. Because why? Because for NASDAQ, for equities in general, what drives NASDAQ or what drives equities in US session is stocks. It's predominantly stocks. Yeah, it's not US dollar, obviously. It's not dollar. It's not this narrative here. It's the stocks. Is the Magnificent Seven. It's the top performing companies. Okay, so this narrative can dice and change if you just focus on this narrative. Understand that as well if you are a NASDAQ trader. Okay, so we can guess risk sentiment by looking at yield. Well, yeah, absolutely. That's the whole point of looking at yields, isn't it? Yeah, absolutely. Yeah. But it's not looking at yields, Ben. What I'm trying to say is you're looking at the relationship between yields and bonds and inflation. Do you understand? It's a relationship between the sentiment lines because we're basing expectation based on how other markets are moving. You can just look at NASDAQ and tell me, there's a risk on market. And I ask you, how do you know? From me, price action just tells me NASDAQ. There's active buyers, in other words, doesn't tell me anything about risk on or risk off, does it? It just tells me this buy is a higher price. Now, the question is, are these buys a higher price correct or wrong? You don't know until you see that. But until you see that, guess what? It's too late because now you're going to sell this price. And guess what? That price is what we mentioned as profit take. We don't sell anymore into this price. We don't sell anymore in that price. We buy to take our sell trades out at that price. Yeah. So hopefully that makes sense. We already see profit taking coming in here. Look, that's what profit taking. That's initial first profit taking. And now we already said we're looking for the 220s as a final profit take, and the value should carry through, and value do carry through right now into that final profit take. So into London close, we should meet this target. That's a target for London close now for the US session, which so far is playing out pretty nice, right? So that's a 300, yeah. So 80-point drop, 80-point target for today's NASDAQ trade, which is quite nice. Why do you tell profit take? Because that's okay. Yeah, I like these questions, Barry. Why do I think that's a profit take? Because the seller sold in here, and the sellers who came in during all of that is going to look to take profits and from this extension. So in other words, the seller who came in during this bracket here. Well, how do I know? Because first of all, seller came in here, and we were those sellers. We are the ones that sold, and then sellers came in again here. So apart from the active selling, obviously the red candles I don't need to explain, right? The red candles are obviously selling. Yeah. So if these green candles, first of all, these green candles, they failed. In other words, when the buyers fail, sellers take control. Sellers are coming in. And then when the buying comes in and it fails again, and sellers are coming in. So in other words, that's the structure. That's that phase there in terms of the sellers gaining momentum in that phase. So if that's a structure, if that's the consolidation from a high to low, back up, because at first buyers were in control, were they not? Buyers were in control because buyers pushed the price to a higher high, and that higher high rejected, and the sellers cycled the price back up to this buyer. So during that phase, that's a structure. That's a structure in terms of a balanced rotational market. So if this buyer fails to defend that level, which they did, then we just drag this box and move it down like this. And the profit take is going to be the low of that box. It's an area. It's not a specific price. It's an area, the low of that price. Because at the low of this price, why do I say it's not a specific price? Because guys, who do you think sold here? It's commercials, obviously. Commercials sold here. So they're not going to look at a specific price at the 220s per se. Because if they have 500 lots, they're not going to get rid of all the 500 lots into that price, are they? they're going to start getting 50 lots out here. They're going to start getting another 50 lot out here, maybe another 100 lot, and then another 100 lot like this. They're going to distribute. So in other words, that's a distribution phase. That's a phase of distribution. That's why I don't want to sell into these low prices, because commercials are distribution. In other words, if you sell, you're selling into the commercials distribution buy. Do you understand? So I don't want to sell. If I want to sell here. I want to sell in line with the commercials. I want to sell this area because that's where the commercials were selling. So I want to sell there. I don't want to sell here. I want to take profits here as commercials were taking profits. Yeah? Do you understand? Yeah. Does that make sense? Does that storyline make sense?
Yes.
Yes. Good. So let's watch if it hits the target. So look. So we can see a lot of distribution happening already, isn't it? Every time it's down ticking, the price is up ticking. Down ticks, up ticks, down ticks, up ticks. What's that? That's distribution. That's commercials distributing the sell position. They're trying to get out of this trade now into London close. Yeah.
Can I ask a question?
Yes, sir.
Well, when the profit taking is happening, how do you enter the trade? And do you know like signature move or something like pattern? Price action, or do you have any setup for trade?
The setup for the trade, right?
Yeah.
Okay. Yeah.
Did you trade
Yeah.
this?
Go on.
Did you trade today? This move?
Well, this is the move that we discussed in the live classroom. Yes. As soon as this candle closed, we were already looking to sell this move. We're already looking to sell the 300 wholesale against that price point here. Any prices higher, we were looking for a sell trade here.
Yes. As for me, the first 5-minute green bullish candle, we don't know it is profit taking or not.
No. We do know.
Yes.
Because
Which zone do you know profit taking is happening? I mean, which candle do you confirm profit taking?
Okay, to answer the question we just discussed, profit taking is an extension into the highs. So if this is the buyer who extended the price, right? This candle who extended the price. So the last seller was here. So we draw, either you can draw a box or you just draw an extension. That's up to you. If we just use the box narrative. Now, what happens is, this is a thing, and this, slipping through, close to target. And that's a target hit, actually, guys. This is a profit take. Full profit take. 220s, isn't it? 220s. Look, and this is reject. Look, Brady, this is how you know this is a profit take.
Yes.
When the price hits into it and it rejects, that's how you know it's a profit take. And it has been profit taking for the last 30 minutes. By profit taking, what I mean is, this is how it works, Barry, in the olden days. Now, as Professor, you weren't here at the time. So back in the olden days, people did not have screens. I mean, price action, people cannot see candles, obviously. But what I mean is, we're definitely going to go over today's, 1 second, Barry, just for you. We're extending a little bit for 10 minutes. I'm desperate to go to the toilet as well, just so you know. So I'm not going to be very long. So what I'm looking for is now, this is how people used to trade, Barry. You have to understand. This. Okay. So you can see that there's no price action, right? In this photo.
Yes.
There's only screens. And that screen is what people call the big board. And that screen is this narrative here on TradingView. Is perhaps this here. Okay, maybe not this. Oh, well, yeah, it's this. Let's look at, I don't know, stocks. The only thing people have access to, Barry, is this. Since they open, it's a percentage change. For example, Microsoft down 1%, Nvidia down 1%, 3%, 1%. That's all people know. And also the closing price from yesterday, because it's measuring against the closing price. This percentage change is against the closing price. right? And that's all people had access to back in, okay, I lost it. Back in the pits, back in the New York Exchange 30 years ago, 40 years ago. Obviously, there was no technology. Yeah. So why is that important? It's important because all they had was a pen and
They don't trade
paper.
like this, right?
They don't trade like this. They don't trade like the way we do right now, 30 years ago, because they don't have technology to do that. Yeah. So what they have to do is, yes, sir. Sorry, go on.
Yeah. Yes, in that photo, one of my mentors said that it is just a demonstration, like yes, like this photo. He said to me that it is like a demonstration for show. You know.
Yes. Yeah. Well, it's a good demonstration. Yeah. Well, your mentor knows. Yeah. Yeah. So that's a good demonstration.
Yeah.
Yeah. Yeah. So
Yeah.
he's correct.
It's not real. Yeah. He
No.
says to me, it is not real. It is like demonstration for show to public.
No. It's not real. It is real. What do you mean by it's not real?
I mean,
How can it not be real? I don't understand. It is real. That's how
uh,
people used to trade in the exchange, like this.
so they trade like this.
Yes, sir. How else do you think they trade? Look.
Oh.
Okay, maybe this is more advanced. Maybe this is maybe 10 years ago. But if we're talking about, look, hold on. This is real. So what does your mentor, how does your mentor think people used to trade 30 years ago, 40 years ago? Well, like,
Around about 20 years.
yeah. So how does your mentor think people used to trade? I can guarantee, definitely not like this, not the way we trade right now. Why? Because they don't have technology to do that. They didn't even have Google back then. So definitely they don't have
Oh,
TradingView.
okay.
Yeah. So this is how people used to trade. They used to wave hand signs. They trade like this. Okay, so your mentor in that case is wrong. I don't know how he thinks people used to trade back then, but this is the reality of trading 30 years ago, 40 years ago. They used to wave hand signs, and those hand signs tells the market, they're trying to get market makers' attention to tell them that I want to get felled. I want 10 lots on NASDAQ. I want to get 5 lots on gold. That's what people used to trade. Look, like this. Yeah, like this. And now you see the badge. You see this says AAR or whatever FR, blah blah blah. You see this. This is whether most likely commercials, maybe commercials, but in other ways, what I'm trying to say is, if the commercials, the people who work for the banks, they will wear a jacket. On the jacket, it will showcase this, something like this. But instead of saying AAR, I don't really know what that means. It will say Goldman Sachs. It will say JP Morgan's. It will say Morgan Stanley. So that people like us knows when the commercials are trading. When the commercials start waving hand signs, guess what? It's time to trade. Everyone now shut up and don't talk anymore because now it's time to do business. There's a lot of noise start to happen because they can see with their eyes that commercials are moving, well, not moving price, but the commercials are trading. Commercials are active, right? So, Barry, what I would recommend you to watch is perhaps the Pits trading documentary. Okay, 2013. That's Floored into the Pits HQ. Oh, okay. I don't know if there is any. There's a movie about the pit trading. So I recommend you to watch the pit trading. 20. Okay, this is maybe quite good. Yeah. So watch something like this, and you start to understand how people really used to
No
trade.
one's proud of that, but you will see
Look.
people go at it.
Well, there was
This
a
is how
lot
people
of
used to trade.
fighting over who did the trade. Did
Okay.
you do it or did the guy next to you trade?
Yeah.
Business.
So
Yes.
yeah. So watch something like this. Look. So what you think this is fake? Or they do this to do what? Yeah. Does that make sense?
So
What's the amount of
profit
noise?
So profit taking come from
Anyways,
come from like this.
yes.
From there.
Look what happened after 2020. Price rejected. Green candle started to form, isn't it? But green candles, these are not buying to go back long. These are not buying to do that. This is buying because the market has shifted lower. So profit taking, okay, in simple, but just obviously now you don't understand the reason. But whenever you see a seller, a seller and a buyer, so whenever you see this shape, this pattern, Ben, whenever you see this, whenever you see a market do this, either this, or let's say a V shape, either when the market does a V shape like this, or a complete N shape like this, an N shape like this, you draw an extension like that. And then you'll see selling here. Anytime, any time frame. Look, so we don't sell against that, do we? Price action, you're going to sell against that. We don't. We take profit here. We don't sell against that. And what's our target? 220s. Has it been met? Yes. Did buying come back in? Yes.
Yep.
Into London close? Yes. So today's narrative on NASDAQ was spot on, wasn't it? Yeah. That's how we trade. Welcome to commercial trading. Yeah. Do you understand? So now, if you want to do some examples, okay, I highlight some examples, but do in your free time. So whenever I see this structure, guess what? Seller's going to come in here. Look, selling do come in here. And whenever I see this structure, guess what? I draw another structure from the high to the lows. And then selling's going to come in here. Guess what? That leads you to here, doesn't it? Yeah. And then guess what? This structure, it leads you to the same price. So there's two sellers here, two sellers from the people who bought here and people who bought here. Isn't it? Yeah. So that's why that level there, definitely no breakout trades. That level above the 300 was not say guaranteed, because it's not guaranteed, because value can change. And when value changes, well, it's not guaranteed anymore. But 90% certain it was a sell trade. 90%, 80%, 90% certain it was a sell trade. From a structure point of view, it may not sell to do that, but definitely it's going to reject first. It has to reject. Hence why at the end of this green candle, you see that it rejected, didn't it? What's that? This. Look at the pins. That's rejection. Derek. That's rejection. That's rejection. Yeah. So we don't buy against that. We don't buy for breakout.
Breakout. Yes.
Okay. On that note, I'm going to finish up. And Barry, if you're interested, well, attend more live streams, because Mark would tell you this is something we discuss every single day. It's no surprise to any of us anymore. Of course, you're new. That's why maybe not something that you're used to, which is good, because now that's something new to learn, isn't it? Something new for you to learn. Yeah. Oh, look.
Yes, thank you for your
And look at the
explanation.
copper buy trade. Yeah. We want to buy copper, and copper played out. Nice. But again, I don't think copper will go, will go bullish to do that. For the time being, guys, for the time being. Why? Because now London closed. Well, not London closed. London was not open. There's today not enough volume, but short term was a scalp buy trade, wasn't it? Short term scalp buy trade. And that scalp buy trade, again, played out in the last 30 minutes. Okay. So, Barry, first of all, I don't know what your mentor's telling you. First of all, I wouldn't listen to a mentor anymore if he thinks if he thinks that's fake. Yeah, no offense, no disrespect, but it's 100% real. Yeah. Otherwise, how do people make money back in the olden days, back in Wall Street? That's how people used to trade. Yeah. So watch some documentaries. Perhaps send it to your mentor as well, so he can watch it. Okay. But yeah, on that note, that should be all from me. And guys,